Okay, be honest with yourself for a second. When you look at the markets right now, are you investing to build wealth, or are you secretly just playing not to lose? You know, it's incredibly common to let financial anxiety and fear of the market dictate your moves, but holding on to that fear might silently be costing you a fortune. Today, we're going to challenge your current investing psychology by looking at a very specific, highly structured way to protect your money without sacrificing your future. Welcome to This Explainer. I'm super excited you're here because today we're breaking down a really powerful wealth preservation and deployment method straight from our source material. It's called the war chest strategy. We're going to look at how to build a financial shelter, secure a solid risk-free yield, and ultimately position yourself to capitalize when the market goes absolutely crazy.
All right, let's dive into this. Here is our roadmap for today. Number 1, the macroeconomic storm. Number 2, the war chest strategy. 3, Black Friday market sales. And finally, number 4, the cash drag trap.
Section 1, the macroeconomic storm, facing the threat.
So let's look at the massive, chaotic external forces currently pressuring our financial markets. $38.7 trillion. Yeah, according to the data, this is the staggering scale of the macroeconomic problem we're facing. And the wild part? Most people are completely ignoring it. I mean, that is a massive cloud hanging right over the market, and it absolutely sets the stage for the turbulence we've been experiencing.
And to make matters even more intense, the national debt is growing by this eye-watering amount, $8 billion every single day. Just let that sink in. That kind of relentless, daily compounding debt fundamentally alters how the market reprices itself. When you see numbers like this, it becomes incredibly clear why investors are feeling so completely on edge right now.
Which naturally leads us directly into a massive wave of uncertainty. We've got the Federal Reserve officially pausing interest rate cuts. We have what the source material calls shadow inflation threatening to push everyday prices even higher. And we have surging oil prices, notoriously known as the boogeyman of the economy. When investors can't reasonably predict what the future holds because of all these factors, well, they sell. And that selling creates wild volatility. Oh, and by the way, the source material actually threw in a picture of a capybara as a mental reward for sticking through all this heavy data, so just take a quick second to picture a very relaxed capybara before we move on to the solution. And this brilliantly illustrates why we need to pivot away from all the chaos.
Section 2, the war chest strategy, building your shelter.
So what exactly is a war chest anyway? Well, it's a strategic allocation of 100% liquid assets designed to provide protection when things go south and serious firepower when assets get cheap. But notice what it isn't. It is absolutely not just lazy money sitting idle in a zero-interest checking account losing value to inflation. No way. It's active, it's intentional, and it is highly liquid.
To give you a really tangible example of this, let's look at the specific portfolio allocation from our source. They utilize a 25% slice dedicated purely to cash and treasuries. But rather than letting that 25% just sit idle, it's actively invested in a mix of tax-free municipal bonds and government treasuries. Right now, that specific mix is earning a blended rate of roughly 4.2%. So it's safe, it's accessible, and it's generating a really respectable return while it waits.
Now, to truly understand the power of that 4.2%, let's compare it to real estate, specifically LA rental properties. The source notes these were netting about a 4 to 5% return on equity. But look at all the baggage that comes with it. You've got $400 permit fees, neighbor complaints, just endless background noise. But on the flip side, the Treasury war chest yields 4.2% with zero work, zero risk, and 100% liquidity. It really highlights just how unbelievably efficient this strategy is for preserving wealth without the headache.
Section 3, Black Friday market sales. Stepping out of the shelter.
Having a shelter is absolutely great, but now let's explore exactly when and how to deploy this financial firepower. You see, the biggest mistake people make is panic selling when the market drops 5 or 10%. But look at the market's historical rhythm. Pullbacks are extremely common. Actually, a 10% drop happens on average roughly every 18 months. And historically, after every major geopolitical crisis, the S&P 500 is on average 5% higher just 6 months later. When you see the data laid out like this, it completely normalizes market drops. It transforms a scary, unpredictable event into a predictable pattern. It's literally an opportunity to hunt for what the source calls Black Friday sales.
Now, what's really interesting about this psychological shift is the supreme peace of mind a war chest gives you. When everyone else is freaking out because their favorite index fund or Bitcoin ETF just dropped 20%, you're perfectly calm. Like the quote says, you aren't worried about your bills, you're worried about how much more you can buy at a discount. That is the ultimate power of this strategy. It turns panic into pure opportunity. Let's move on and see how this builds into our final section.
Section 4, the cash drag trap, knowing when to rotate.
Because believe it or not, there's actually a danger to staying inside your shelter for too long. This is what the source refers to as the playing not to lose trap. It's incredibly easy to get entirely too comfortable sitting on a safe 4% yield. But over time, holding too much cash becomes a massive drag on your long-term wealth. You have to execute what's called the Great Rotation. This means actively moving that idle cash into opportunities, like beaten down international index funds. Or, if you're following the quirky footsteps of our source material, rotating it into niche investments like a signed Tommy Pickles animation cell, or celebrating with a picture of an otter. The point is, your money must eventually go back to work.
And hey, if you're still nervous about rotating that cash back into the market, I want you to memorize this number, 99.8%. This represents the historical probability of the market being profitable if you simply hold your investments for a 15-year period. It's the ultimate reassurance that, over the long haul, betting on the market is overwhelmingly in your favor.
So the crucial point here is that consistency is key. You should absolutely maintain your regular dollar cost averaging. Your war chest shouldn't replace your daily investing habits. Instead, treat it purely as a break glass in case of emergency fund for when the market negatively overshoots. Run your own numbers, factor in your personal stress tolerance, and always make sure your portfolio is working for you, not the other way around.
Which brings us to the final thought I want to leave you with from our source material. Take a hard look at your own financial strategy today. Are you building up a safe, strategic war chest right now to prepare for the storm, or are you going all in on the markets? It's a really critical question to answer as you plan your next move. Thank you so much for joining me for this explainer. I really hope this brought some serious clarity to your financial strategy, and keep learning.